Capital budgeting refers to analyzing the cash inflows and outflows of a particular project to see if it makes financial sense to proceed with it. And this is important right now because of the Fed interest rate cut that's proposed that a lot of people are expecting in September. The reason that is that the discount rate used to discount cash inflows and outflows to present value depends in part on where interest rates are generally. So if the Fed cuts interest rates, that affects the calculation. So to give you an example, let's start with present value. Present value is simply the method of taking a future stream of payments and discounting them back into today's dollars. So let's do an actual example that happened a while ago. Delta Airlines spent a lot of money revamping planes to create a premium first class section that had much bigger seats and much bigger leg room. They took existing planes and spent money to renovate them. The payoff was that they were going to charge premium seating prices and that people in the future were going to be willing to pay more for premium seating. So let's imagine this. Let's imagine that in year zero, at the very beginning, you're going to write a check for $10 million to renovate a plane. And that for 6 years, Delta's going to receive $2 million a year in additional cash inflows from selling premium seating for the plane that they renovated. To give you an example, let's think about the discount rate as 5%. To give you an example, discounting in year 3 at 5%, you multiply the $2 million cash inflows by 0.864 to get it in today's dollars. So if you can imagine a chart, $10 million year zero at the top, $2 million coming in every year for 6 years. We multiply it by the present value, and we come up with a sum of all those cash inflows and those cash outflows based on present value. The present value, by the way, in year zero is dollar equals dollar, so there's no adjustment. It turns out that if you go through that example, the sum of the cash inflows and outflows is a positive $152,000 number roughly. What that means is that you decide to do the project because the present value of the sum of the cash inflows and outflows is positive. Now, let's tie it back to the Fed rate cut. Why does that matter? If the Fed cuts rates, people who are performing the analysis will use a present value that is lower than the present value they use now, which means that the payments are going to be worth more because they're discounted less, so that the sum of the present value of the payments will be higher because the interest rate will be lower. That's the impact of a Fed rate cut.